Hello, financial enthusiasts! Welcome back to Stock Market Callus, where we reveal the secrets to financial success and building a solid foundation for a brighter future. If you've been following along, congratulations! You've already embarked on an exhilarating journey into options. In our first chapter, we explored the power of analogies using insurance comparison to demystify options. And today, we're revisiting that analogy because understanding options as insurance is the key to grasping their pricing dynamics. Today, get ready to unlock the secrets behind what makes an option's price dance and groove each day. We'll dive deep into the three essential factors that set the rhythm for an option's price movement. Once you grasp the impact of these three factors daily, the doors will swing wide open and we'll explore various strategies that can turn your options trading into an exciting and profitable adventure. Number 1, the price of the underlying stock. Number 2, time to expiration. And number 3, the volatility of the underlying stock. As we journey through this chapter, we'll break down each factor step by step so that you'll have all the tools you need to become a savvy options trader. Let's start by discussing how an underlying stock's price affects its options price. Let's recall the basic definition of a put option. When you buy a put option, you acquire the right to sell the stock at a predetermined price on or before a specific date. This predetermined price is known as the strike price. For instance, consider Twitter stock and its options expiring in 28 days. If you currently own 100 shares of Twitter stock, purchased at $18 per share, you could buy the $18 strike put option, similar to purchasing comprehensive insurance. Should something drastic happen, causing Twitter's stock price to plummet, your put option would enable you to sell your shares of stock at the agreed upon price of $18 per share, exactly where you initially bought it. This holds true regardless of the current market price being much lower. Now, if we look at the option pricing, you'll notice that the $18 strike put option costs approximately $159. To calculate the cost for 100 shares or one contract of this $18 strike put option, you would multiply $159 by 100, totaling about $159. Now, let's consider if you were to opt for the $16 strike put instead. As you can see, the cost would be significantly lower, approximately $75 for one contract. This reduced cost is because this put option would only provide insurance for $16 per share of your investment rather than the full $18 per share. Now, let's shift our focus to a completely different example. Imagine you hold the $120 strike call option on stock XYZ. Unlike before, you don't own any stock. You solely possess the call option. This call option grants you the right to buy shares of XYZ stock at the strike price of $120. Let's say the stock's current market price is $125 per share. In this case, with the current stock price at $125 and your option allowing you to purchase the stock at $120, the option would be worth at least $5. You will instantly profit $5 per share if you exercise the option. In this scenario, we refer to the option as in the money because it holds value, enabling us to buy the stock at a discounted price compared to the current market value. So, once again, this option is categorized as in the money. Let's consider one more scenario. You still hold the $120 strike call option, but this time, the stock's current price is much lower, sitting at $115. So, if you possess an option that grants you the right to buy the stock at $120, the stock's current market price is below $115. If there's no time left until expiration, how much will this option be worth in such a case? It's going to be worthless. Why? Because nobody in their right mind would want to exercise their right to buy the stock at $120 when they can easily purchase it at the current market price of $115. In this scenario, we would refer to this option as out of the money. The reason is that the call option strike price is higher than the current stock price, thus not allowing us to purchase the stock at a discounted rate. Once again, we refer to this as out of the money. Now, the cool thing is that if we examine an option chain, the in-the-money and out-of-the-money options are conveniently highlighted for us. The in-the-money calls and puts have a bluish shaded background, while the out-of-the-money calls and puts have an empty or black background. To reiterate, the in-the-money calls are those with a strike price lower than the current stock price, while out-of-the-money calls have a strike price higher than the current stock price. On the other hand, for puts, it's the opposite. In-the-money puts have a strike price higher than the current stock price, and out-of-the-money puts have a strike price lower than the current stock price. Now, this is where it all starts to click together. You'll notice that the further in the money an option is, the more expensive it becomes. This is because options that allow you to purchase the stock at a larger discount are inherently more valuable than those that offer only a small discount. Here's the key point. Stock prices constantly fluctuate, directly impacting the value of call and put options. Let's break it down. If you own a call option and the stock price increases, your call option will increase in value. This happens because the call option becomes increasingly in the money. Likewise, if you own a put option and the stock price fails, the value of your put option will increase. The put option gains value as it moves in the money. Suppose you buy an option today and are curious about its worth at the expiration date. It will simply be valued based on the difference between the stock price and the option's strike price. Simply put, the option's value is determined by how in the money it is. This aspect is also known as the intrinsic value of the option. At the expiration date, an option will be worth its intrinsic value. To illustrate this, let's examine the options nearing expiration for Twitter. These options have very little time left before they expire. The current stock price is $18.09, and if we focus on the $17 strike call option, we can observe that its value is around $1.05 to $1.14, averaging approximately $1.09. The $17 strike call option would allow you to purchase the stock at a discounted price of $17 per share, saving $1.09 compared to the current market value. If we move slightly further in the money, we see the $16 strike call option valued at around $2.09. The $16 strike call would enable you to buy the stock at a discount of $2.09 per share. On the other hand, if an option is out of the money, it will be worthless at the expiration date. Nobody wants to buy stock at a higher price than the current market value. Similarly, out of the money put options will be worthless since no one wants to sell stock at a lower price than its current worth. As you can observe, all the out of the money options have no value. To summarize, at the expiration date, in the money options will be worth the difference between the strike price and the stock price, while out of the money options will be worthless. However, when we look at options that have more time until expiration, even the out of the money options still hold value. This might lead to the question, why do they possess value now if out of the money options will be worthless at expiration? This leads us to our next point, which is time to expiration. Let's discuss how the time left until an option's expiration affects its price. Think of options like insurance. You pay a premium to have them. But, just like insurance, it's not a one-time payment. You must keep paying to keep the coverage. The longer you want the option valid, the more you must pay. Options have expiration dates for a similar reason you make monthly payments for car insurance. For example, if you insure your car for 6 months, it might cost $600, but if you want coverage for 12 months, it could cost $1,200. Similarly, the time left until an option's expiration greatly influences its price. An option with 60 days until expiration will be more expensive than an identical option with only 30 days remaining. The longer the time left, the higher your price for the option. This effect of time on the option's price is called time decay or theta. In the previous section, you learned about in-the-money and out-of-the-money options. Out-of-the-money options are those with a strike price that doesn't allow you to buy or sell the underlying stock at a better price than the current market value. Consequently, these out-of-the-money options are considered worthless, but this is only true when there is no time left. Let me clarify using an example. Suppose you're currently looking at Twitter options that expire today with 0 days left until expiration. As expected, the out-of-the-money options are worthless and are worth 0. Let's focus on options that still have time remaining until expiration. For instance, let's consider options with 28 days left until expiration. In this case, the out-of-the-money options with 28 days to expiration have value. You might wonder why they have value now if they won't have any value at the expiration date. The reason is that stock prices are dynamic. They can move. As long as there's time left until expiration, there's a chance that the out-of-the-money option could become in the money. Therefore, these out-of-the-money options retain value because there's still an opportunity for the stock price to change and bring the option in the money. To put it simply, consider the analogy of purchasing car insurance. When you buy car insurance, you don't know if it will be worth your price. It may seem expensive, but you're uncertain whether you'll have an accident. Similarly, although out-of-the-money options may seem to lack value now, their worth remains uncertain until the expiration date due to the dynamic nature of stock prices. As you can observe, the further an option is out of the money, the more affordable it becomes. This is because the likelihood of it having any value is lower than an option with a strike price closer to the current stock price. Let me explain further with an example. Imagine this stock is currently trading at $18 per share, and you're considering two call options, one with a $20 strike price and another with a $25 strike price, both expiring in 28 days. The option with a $20 strike price is more likely to have value at expiration because the stock would only need to make a small move to reach $20 per share. On the other hand, the stock would have to make an extremely large move to reach $25 per share, making it less likely for the $25 strike call option to have value at expiration. Therefore, the $25 strike call option will not cause much because it is less likely to be valuable at expiration. Now, let's review the prices of these options again with 28 days until expiration. If we fast forward to the expiration date or 0 days remaining, you'll notice that all out-of-the-money options become worthless while in-the-money options are worth the difference between the stock price and the strike price. At this point, no more time value is left on these options, also known as extrinsic value. Extrinsic value refers to the amount by which an option's price exceeds its intrinsic value. Intrinsic value represents the in-the-money portion of the option's price. Simply put, it's the value you would gain if you exercise the option immediately. As mentioned earlier, let's revisit the options with 28 days until expiration. Take the 17 strike call option with a current price of $2.20 and the stock trading at $18.09. This means the 17 strike call option is $1.09 in the money, making its intrinsic value $1.09, and the remaining value of $1.11 is its extrinsic value. All extrinsic value will vanish at the expiration date, and its intrinsic value will solely determine the option's worth. Now, let's consider what this means practically. Suppose we buy this call option now at $2.20. If the Twitter stock remains unchanged and trades sideways for the next 28 days, the option's price will gradually decline from $2.20 to $1.09. Since option prices have a multiplier of 100, the net loss on this trade would be $111, even though the stock price didn't move. To profit from this call option, Twitter stock would need to increase enough for its intrinsic value to surpass the premium paid for the option. For instance, if we paid $2.20 for the 17 strike call, we would need the stock to reach $17 plus $2.20, totaling $19.20 to break even at expiration. Currently, the stock is at $18.09, so it would have to rise significantly to reach $19.20 for us to break even. This is why we stress the importance of caution before buying calls on every stock we expect to go up or puts on every stock we expect to go down. Options cost less than trading actual stock shares and experience time decay. As time passes, the options lose value, making it challenging to profit if the stock doesn't move significantly in our favor. Options constantly lose value as time passes, which is precisely why we avoid trading options this way. We don't use options to predict the direction of the underlying stock. Instead, we employ them to take advantage of time decay. In this course, you will learn various strategies to achieve this. We want to clarify something quickly to prevent confusion. An option's extrinsic or time value gradually diminishes over time. So, if you buy an option today and the Twitter stock moves up to $19.20 tomorrow, you can still make a considerable profit because there will still be some time value remaining on the option. Regarding the break-even we discussed earlier at $19.20, it's essential to understand that it applies to the expiration date. But don't worry if this sounds confusing. We will delve deeper into this topic shortly to provide more clarity. We'd like to emphasize that you don't have to hold an option until its expiration date. You can open and close the trade at any time before the expiration date, giving you more control over your options trading strategies. Now, let's talk about the final factor, volatility. Many options traders focus solely on the first two factors we covered earlier and overlook this critical third factor. Consequently, they struggle to make profits in options trading. Paying close attention is essential because volatility is equally, if not more, critical than the other factors. Understanding volatility is key to finding success in options trading, and the good news is that it's not as complicated as it might seem. So what exactly is volatility? Volatility simply refers to the extent of a stock's price fluctuations. When a stock exhibits high volatility, it experiences significant price swings, while low volatility implies minor price movements. Consider this. If you own a stock as an investment, the stock's volatility becomes an essential measure of your risk. A stock with high volatility, characterized by large price swings, exposes you to greater potential losses in your investment. In contrast, low volatility stocks entail smaller price swings, indicating a lower risk. Due to the higher risk associated with high volatility stocks, options linked to such stocks will be more expensive. Let's revisit the insurance analogy once more. If you purchase an option to safeguard your stock investment, you pay the option seller to assume your risk. Naturally, if your risk is higher due to the stock's high volatility, the option seller will demand more money for taking on that added risk. In summary, the level of volatility in a stock affects the pricing of associated options. Higher volatility leads to more expensive options, reflecting the increased risk for both option buyer and the option seller. Let's illustrate this concept with an analogy. Imagine you are an insurance company offering life insurance to two different individuals. The first person is overweight, smokes heavily, and has a serious medical condition, while the second person is healthy, exercises regularly, and has no life-threatening medical issues. In this scenario, who will have to pay more for life insurance? Naturally, it will be the first person at a higher risk of facing health issues or death. Now, let's relate this to the stock market. Consider a stock with high volatility as the first with significant health risks, and a stock with low volatility as the second person in good health. Like the unhealthy person will have to pay more for life insurance, a high volatility stock will have more expensive options. On the other hand, just as a healthy person pays less for life insurance, a low volatility stock will have cheaper options. So, the level of volatility in a stock determines the cost of its associated options. High volatility stocks come with more expensive options due to the increased risk, while low volatility stocks have cheaper options as they pose a lower risk in the market. We've selected two companies with stock prices that are nearly identical, and we have their respective option chains displayed side by side for you to compare. On the left side, you can see EWZ, and on the right side, FXI. The price difference between the two stocks is minimal, just 6 cents, practically negligible. Additionally, the options shown on your screen share the same 28 days until expiration. Therefore, we have two companies with similar underlying stock prices and the same remaining time until expiration. Now, let's take a look at this scenario. The implied volatility, which represents the expected volatility for EWZ over the next 28 days, is approximately plus or minus $2.44. This means it is expected to trade within a range of $2.44 over the next 28 days. On the other hand, FXI has an implied volatility of around $1.89, indicating it is expected to have a smaller price range of $1.89 over the same period. In simpler terms, this shows that EWZ is anticipated to have higher volatility, meaning it is expected to experience more significant price movements over the next 28 days compared to FXI, which is expected to have lower volatility with smaller price fluctuations. Despite having the same underlying stock price and the same time remaining until expiration, their different implied volatilities lead to variations in option prices. For instance, look at the 37 strike put option on EWZ and FXI. The put option on EWZ is priced at around 85 cents, while the put option on FXI is only 54 cents. This difference in option prices demonstrates how a stock with higher expected volatility, like EWZ, will have more expensive options, while a stock with lower expected volatility, like FXI, will have cheaper options. And it's not limited to the 37 strikes put. You can see that puts and calls at every strike are more expensive for EWZ than FXI. Simply put, high implied volatility results in expensive options, while low implied volatility leads to cheap options. It's like the analogy of high-risk insurance costing more and low-risk insurance being cheaper. Let's discuss how this impacts your trading. Similar to how a stock's price can rise or fall, its implied volatility can also experience changes. When the implied volatility increases, both call and put options become more expensive. Conversely, if the implied volatility decreases, options become cheaper. But you might be curious about what causes implied volatility to fluctuate. Here's the key. The implied volatility of a stock is determined by its options prices, not the other way around. In other words, the prices of options directly influence the stock's implied volatility. Allow us to clarify it differently. Option prices indicate a stock's expected move, also known as implied volatility. Think of it this way. The option prices are like a source of information that generates the implied volatility number, revealing the stock's expected move. You might still wonder about the factors driving a stock's price to rise or fall. Essentially, it all boils down to the principles of supply and demand. If many buyers are interested in a stock, its price will increase. But if there's a surplus of sellers, its price will decrease. Options work similarly. A surge in option buyers will lead to more expensive options, while an influx of option sellers will cause options to become cheaper. These variations in option prices, in turn, determine the implied volatility. So, to answer the question of what causes implied volatility to change, it revolves around the factors that would create a substantial interest in either buying or selling options. Think of options as insurance. Investors who feel uncertain and worried about risks, they buy options to protect their investments, expecting higher market volatility. This increases the demand for options, causing their prices to rise, which results in a higher implied volatility number. Implied volatility acts as a fear gauge, reflecting investors' uncertainty. If this explanation seems overwhelming to a beginner, don't worry. For now, grasp that if a stock's implied volatility rises, its options become more expensive, while a decrease in implied volatility leads to cheaper options. Understanding implied volatility is crucial to our trading strategy because it is more predictable compared to stock prices, which can be highly unpredictable. In summary, these three factors, stock price, time to expiration, and implied volatility, play significant roles in determining an option's price. Embracing this knowledge will pave the way for successful options trading. Thank you for joining us today, and see you in the 4th episode of the series on options trading. In the upcoming video, Investing for Beginners Options Trading Part 4, we will estimate how an options price will change concerning the movement of the underlying stock, the passage of time, and changes in market volatility. While you wait for the next update, don't miss our latest video, Investing for Beginners Options Trading Part 2 of our trading series.